Recording in progress.
Preeti, you may start.
Good afternoon, everyone. A very respected past president, CA Shri Amarjit Chopra ji, the past Central Council member, MP Vijay Kumar ji, C. Srinivas Joshi ji, Himanshu Bhai Kisnadwala, Bhaskar ji, the chairperson of the committee, Sri Priya Madam, my council colleagues, Abhay Chhajer ji, and all dear friends. Welcome all of you to this panel discussion, and to begin with, I request all of you to put your hand on the heart to have, and I request the Institute office to start with ICI motto. Sarika?
Ma'am, we are not running this motto song.
We'll try and do it from the next webinar onwards, because normally we didn't know this. So we can, you may continue with your address, Preeti. Because a lot of people would be sitting, so there was a little reluctance on whether the motto can be played.
No problem. So ICI is always at our heart and in our mind and our soul. So to begin with, now let us begin this, the very important session for today, CARO 2020, which is newly mandatorily applicable to everyone, all the companies, the corporate governance and the role of auditors. And we have a fantastic the panelist to address on this. And to begin with, I request Sri Priya Madam to give her opening remarks.
Thank you, Preeti Sarlaji. I'd like to, on behalf of the Institute of Chartered Accountants of India, I'd like to extend a very, very warm and a very hearty welcome to every one of you who's attending this program, and particularly to CA Amarjit Chopra sir, past President ICAI, CA MP Vijay Kumar sir, CA Srinivas Joshi, CA Bhaskar Selvam, and CA Himanshu Kishnadwala, who are here as panelists. And in order is also a very warm welcome to CA Abhay Chhajer, Central Council member in the current term. So, and thank you to thank in advance our Secretary Sarika Singhal, who's always here to help us. So without much ado, I would do a bit of context setting slightly later, but we could start off with a very good opening set of remarks from CA Abhay Chhajer. He'd speak for a couple of minutes, about 10 to 15 minutes, on exactly where we are heading with this CARO, what's it all about. Over to CA Abhay Chhajer.
Yeah, thank you so much, Preeti, Madam, and Shri Priya Madam, for giving me this opportunity. All the respected participants through virtual, and especially our past president and a mentor, and I've shared dais so many times. It's always an opportunity, to sit with Chopra sir. And of course, I missed the opportunity with working with MP Vijay Kumar ji as a Central Council member, and of course, Srinivas Joshi ji, and the panelists Himanshu ji and Bhaskar ji. So it's a opportunity for me to be here, and nothing. I would say, of course, a great opportunity. But when you see those faces in front of me, who are ready to deliberate and who are panelists, I would say, Shri Priya Madam, you've actually put me in trouble to share my experience, because I think the experience what I'll gain listening to all of them would be significantly so high that it is unmatchable. So, but still, I would share a couple of my experience for a few minutes in terms of the CARO, where you've said that how it would be as part of, or would be in line with, the corporate governance. Of course, the CARO implementation, which is now applicable, the clauses 21, which now the auditor's responsibility has tremendously increased in terms of the reporting requirement under CARO, and effective the financial year 21-22. So now each clause, if we have gone through the clauses, I'm sure there is so much responsibility which is now shifted to the auditors, new clauses being added, old clauses being modified. So much changes, and I'm so surprised that being an auditor, giving an absolute assurance on each such clause. In fact, not just 21 clauses, I would say there are 47 sub clauses which have been there in the reporting requirements. So there's a big responsibility for each auditor, and looking to the time we spend on audit, the fees which is being charged, of course, may not be appropriate forum, but definitely there's a lot of requirement which is increased, and I think a big responsibility on each auditors where the CARO is or the clauses being to reported. And more particularly when, if I talk about no parallel compliance requirement in terms of the reporting by the management and corporate governance. So if I say that clauses like transactions not recorded in books, clauses like the internal audit systems, which of course was there earlier, now again been added, clauses where loans investments are to be reported. So there's so much responsibility given on the auditors. And parallelly, if you see the corporate governance, there are no change. There's still the reporting requirement is the same. So if you see that as an auditor role, of course, we can definitely contribute much in terms of, helping the audit committee or even to the management in improving the corporate governance. But if I talk about the governance, then, where the management is accountable, management is responsible, is transparent, is fair, there's so much which is to be reported. But if I talk about CARO, if a good governance not there or in a company, then the responsibility is even much higher. So I think there's a lot of deliberation which will be required going forward on how the auditors have to report, how the corporate governance, where we'll have to see that could be improved by the auditors in assisting the management and even to the audit committee. Oversight of financial reporting process, the accounting policies, practices, how it could be implemented, then compliance of various accounting standards, and strengthening the internal control system. So I think the role of auditor has tremendously increased in terms of the reporting requirement, and also in assisting and improving the corporate governance for the entities. So, like I said, an absolute assurance we give in the CARO, and this would really be very tough for each auditor giving compliances, checking the compliances, and even reporting the non-compliances. Because for a stakeholder, now if the corporate governance, there are no reporting, but if the CARO has certain non-compliances, certain non-compliance in terms of laws and regulations which are reported, would be really difficult even for an entity, to respond to the stakeholders. So I think there has to be, a big role which the auditor has to play, and to plan even our audit procedures in such a way that if there is a good corporate governance, it would really help us, in planning our audit procedures effectively and efficiently in performing the audit. Or would be very difficult as an auditor if there are non-compliance. So I think having such experts in this today virtual discussion, we would definitely get insight about each such clauses, and the questions which would be deliberated would be an opportunity for all of us to do an audit effectively and efficiently. So thank you very much for giving me this opportunity.
So thank you, Abhayji, and once again, a pleasure. I'm given to understand we have about 1,750 plus participants and more logging in, which I think is a good number. And I presume all of them are actually serious viewers. The other interesting thing is that we intend to, this is a completely recorded session, so it's available for students and members alike. In terms of setting the context, I'm very happy to do this panel discussion, and I have said this before, extremely thankful to these 5 gentlemen who've offered to come in here today. Each one of them truly eminent in the way they operate. Legislations in world history are never proactive. They're always reactive. They're reactive to a way a civil society behaves or misbehaves. I don't think Companies Act 2013 was any exception. And in a matter of significant deepening, I think CARO 2020 and the amendments to Schedule 3 are in the same line of thought. There's obviously something that's prompted this change. And to label it a change seems like using a very insignificant term. And in the context of the wars that we see around us, I'd rather, label this a surgical strike. It seems to be a very conscious effect of those in the government to get very pointed responses in Schedule 3 and very pointed certifications in our audit reports. And that's my take on Schedule 3 and CARO. And it seems to be like a very aggressive surgical strike to open out everything that's there in the reporting context. Now, obviously, we'll be going through many CARO and Schedule 3 webinars. But how does this panel discussion propose to be different? I think as chartered accountants, the viewers in this context of this discussion would either be those in managements or actually doing up the Schedule 3, or those who are going to be auditing the Schedule 3 in terms of the CARO 2020. Not just in terms of reporting under CARO 2020 and audit of the financial statements. Now, I think our own effectiveness gets improved if we understand why this CARO element or a Schedule 3 element changed. And two, how do you ensure that you perform your role to deliver that expectation of corporate governance? So the corporate governance is the spectrum is pretty wide. You have the board of directors, you have the shareholders, you have the bankers, you have the regulators who are aplenty in this country. You have the board of directors. And of course, in that control onion of corporate governance, the internal audit is the last but one layer, and perhaps the statutory audit is the last layer. So CARO and Schedule 3 are indeed, in my view, tools of corporate governance as well. Now, and that's exactly what we are going to discuss. So the how, the what of CARO and how it connects to corporate governance. Very often, we are often spoken as being partners in nation building. So how do you truly partner in nation building? You partner in nation building when you pursue an ethical conduct, A, which is obvious because all of us do, and two, strictly stay aligned to what the principles of corporate governance are. With these few words, I'd like to now throw open my questions and my requests for this panel discussion. So revisions to CARO and revisions to Schedule 3. And why do we say this very, I use these terms interchangeably because I think the origins of CARO are expected to come from Schedule 3. This is all about strengthening corporate governance. The first part of this presentation for the next maybe 40-45 minutes, I would like each panelist to present their views on whether these changes were A, needed at all, and if so, how CARO and Schedule 2, CARO 2020 and Schedule 2 will strengthen the principles of corporate governance. And of course, you may add your opening remarks, 5 minutes each. And and in doing so, I put together some important elements of corporate governance in order to make sure that the panelists don't repeat. The first aspect of corporate governance is, of course, transparency. Would like Mr. MP Vijay Kumar to deliberate on his opening remarks on CARO and how CARO will be a tool to enhance transparency, which is one of the cornerstones of corporate governance. Over to Mr. Vijay.
Thank you, Sri Priya. Thanks for the opportunity to be part of this panel discussion on such a very important topic and so very timely. Let me begin with setting the context of some of these changes which are promulgated through law by the Ministry of Corporate Affairs. And for this, in my view, it's very important that all of us as stakeholders should understand the mission statement of the Ministry of Corporate Affairs. I'm not sure how many of you have gone through. Ministry of Corporate Affairs has this very beautiful mission statement which talks about empowering business and protecting investors. And if you actually look at most of the actions which emanate out of the Ministry of Corporate Affairs, they are aimed towards either of these or both of these, either of these or both of these. And if you look at CARO 2020 and the Schedule 3 amendments which followed immediately, they are meant for both of them. It's meant for both of them. And let me share my understanding of the way these amendments have evolved. I have heard a lot over time about people talking about expectation gap, that we perform work as per standards, and the stakeholders, be it regulators, investors, they have a expectation, and the work we do as per standards is actually not meeting their expectations in terms of the information which they want, which will give them adequate confidence about the company with which they are engaged in. So we have heard about this expectation quite some time. So what CARO 2020 and the consequential Schedule 3 amendments seek to do is bridge that expectation gap. So as stakeholders, be it the investors, lenders, or regulators, we have always been concerned about a few things. We assumed they would be there, but we found it wasn't there. So I wanted a specific observation of this for us to come to a conclusion that it is safe for us to stay engaged with this business, empower the business to grow, and consequently our interest also to be protected. So it is in this context that these amendments have come in. Personally, having taken the step of having a shrunk version of CARO in 2015 compared to the 2003 CARO. So if you look at 2003 CARO versus 2015, it was a shrunk version. Much of the clauses got deleted. It was a very strong message to the professional community and the corporates that here is a government which was willing to walk its talk of less government, more governance, ease of doing business, and consequently it was a very, very shrunk version of CARO. I was very excited about that version of CARO because directionally what it meant is the stakeholders are having confidence. So it's not necessarily to keep telling every time that I'm doing this, I'm good, I have this procedures, I have this controls. There's no need to keep on reiterating it. So it was a good directional step. Unfortunately, the experiences of that little bit of a liberalized approach wasn't yielding results in terms of distinguishing the good companies from the others and helping overall investor confidence go up. We have had a series of corporate failures, the experience of insolvency law in terms of number of entities which went bankrupt or approached IBC despite signing off 3 months back that it was a going concern. They were pretty disturbing. And it was in this context that I think MCA was left with no choice, except that probably increase a bit of coverage explicitly where the stakeholders, both the managements through Schedule 3 and auditors by giving their response on financial statements and through CARO, give needful assertions, which will improve the confidence of the stakeholders at large. My own personal wish is that all of us, if we can collectively ensure that the governance standards improve, and CARO subsequently, when it is revised, I don't know when, 5 years from now, whenever, it becomes a shorter version of what it is now. And that would be a strong reward or a good reward of the fact that our efforts towards improved governance have yielded results. And if more clauses get added in due course of time, that will be a message to us that we haven't yet corrected the way we have to. I think that's the bottom line. So I sincerely wish that this particular CARO 2020 and Schedule 3 amendments help improve the overall corporate governance. And with this kind of transparent reporting which is coming in, it will enhance investors' confidence in the entities as well. These are my opening thoughts, Sripriya.
So thank you, sir. And that, ladies and gentlemen, was CA MP Vijay Kumar, a legendary teacher, a professional par excellence, a 2-time Central Council member, and a director on the Life Insurance Corporation of India at its most, if I may say, sunrise hour. So thank you very much, sir. Although I personally feel, and I can come back to this later, look at it this way. I would think that they had nowhere else to go. They said, okay, so let's put everything in the auditor's report and let's see if the audit fraternity can rise up. So I would also think, with several parts of the corporate governance spectrum not really coming up to the mark, whether it's the credit rating agencies or whether the institutional frameworks themselves. So maybe, it's also a sign of confidence reposed in the auditor, but then I'm sure there are alternate views. I'd like to next invite and introduce our next panelist for the day, CA Shri Amarjit Chopra, sir, past president of the Institute of Chartered Accountants of India, part of NACAS, NAFRA. So here's a very, and of course, an exemplary professional. I run out of adjectives because all of them are just the same. And the nice thing about Chopra, sir, is that anytime you call him for an address, I think I've had 100% hit rate, and I'm sure most of us have. He just manages to make the time. So it's now over to Chopra ji. The second element of corporate governance is about independence and fairness. Independence and fairness of conduct of the management with all its stakeholders. Your opening remarks on this CARO 2020 and Schedule 3 changes, and whether it's actually going to strengthen that pillar of corporate governance, which is independence and fairness. So your views, please.
Thank you, Sripriya. Number one, I would like to thank you for the opportunity and giving me an opportunity to share some of my thoughts along with the 4 very eminent panelists. And I can tell you the way I rate MP Vijay Kumar, I feel saddened that he is not in the council, frankly speaking. I have been telling this to him. I feel bad that he is not there in the council because the institute, the profession loses out on a very good professional so far as the council is concerned. The other thing that I would like to say is that, you see, when you talk of independence, there will be certain things that I would like to touch upon because I was chairing this particular committee which has revised CARO, as the luck would have it. Even 2003 CARO was brought in by me. Before that, it was CARO, very frankly. Manufacturing and other companies' auditors report order. At that time, the government said that probably the auditors are reading it as mild and otherwise cooperative auditors report order. Because every time you read, the auditor would say that fixed asset register is under updation. And still, he is able to say that the differences between physical verification and the books have been reconciled. I don't know how. If a particular register is under updation, how could you do that? It is anybody's guess for that matter. And there were many other things. I don't want to get into that. So we said, in any case, Maoism is dead all over the world. So why to have Mao CARO somewhere in India? So let's have CARO, kuch to karo. Let's do it that way. So CARO 2003 came at that particular point of time. It was also arising out of a particular scam. Let's be very clear about it. And then came this one. It was also sort of a knee-jerk reaction. But I can tell you one thing. When this came in, and the committee was discussing at that time, the ROCs were there. The 4 big ROCs were there, and they wanted about 88 clauses to be there. Virtually everything possible on the earth was to be there. We put our foot down from the institute side. Myself was there, Sanjeev was there, and Shekhar was there. That if you want to hold the auditor responsible, hold the management also responsible. You must understand why this Schedule 3 has been revised. We, in fact, also wanted company secretaries to be held responsible for certain acts. After all, who will define what is a related party and who will tell which is the related party? Why should I come into play so far as that particular part is concerned? Unfortunately, that has not come in so far, but I'm sure with the passage of time, even that would come. Because certain responsibilities will be cast upon the company secretaries also. I'm very clear so far as that part is concerned. When you talk of the independence of the auditor, I have always believed in one thing. It is to a very large extent state of mind. But at the same time, somebody must empower the auditor also. I have always looked at these changes from the other perspective. I have not looked at it that my job has become more onerous, that it is becoming difficult. Abhay said that absolute assurance. Fine. If my report desires me to do something, I can go to the management and say, no, I want this information under all circumstances. And if you don't provide me the information, I'm going to do this. Please read out the report. It is not my report. It is not even given by the institute. It is given by the MCA. It is not under SA 700 or 705 or 706. Let's be very clear about it, which they may not recognize. But when you say that it is by MCA, they do recognize that. I still remember till the time section 209, 210 were there in the Companies Act, were not amended to bring in the concept of accounting standards being mandatory to be followed. The management would always say, what accounting standard? And I will show them that pink book and will say it is Bible for me. They used to say it is Mahabharat for me. They will not bother about it. But the moment that section came in and director's responsibility statement come in, it improved the governance level to an extent, so far as the compliance with the accounting standards are concerned. Similarly now, I think I look at it, I have become more independent. Very frankly, it gives me that status. Because I will go to the management and say, no, I have to do it. I have no choice, basically. Of course, independence will always remain a state of mind, but also look at it so far, what we are doing with regard to the, I think Vijay referred to certain practices or certain experiences with the insolvency. Right now, the institute needs to conduct a study. I personally feel you at the head of the governance committee, the corporate governance committee, you need to conduct a study as to what has happened in these insolvency cases. Why banks had to take a haircut of 70% on an average. And you will find startling revelations, very frankly. You will get startling revelations. Why it has happened? What was happening to the stocks? What was happening to the debtors? What was happening to the creditors? All these things would be reflected. So if I was not willing to go with SA 240 myself, now the SA 240 will have to be complied with so far as the inventories or debtors or creditors, etc. are concerned. I personally feel independence has to be maintained in all circumstances. This CARO 2020 I as an empowerment for me. You see, when CARO 2003 came in and it talked of frauds, this was one clause which we did not give, very frankly, from the committee at that time. And I still remember Mr. Chandak visiting MCA a number of times and saying that please don't don't bring in this particular clause, you can substitute another 3 clauses for it. But the MCA said nothing like, we want these clauses to be there. So far as the fraud to be reported, whether any fraud has been noticed or reported either by the management or someone else. So I think that was very important. But somehow again, whether any fraud was ever reported or noticed, I don't want to comment upon that. Again, that can be a part of the study, whether it has happened or it has not happened. So now MC has said nothing doing. Even management will be held accountable. Now management will have to say, you look at the position, capital work in progress, languishing for ages. You keep on showing something as capital work in progress without, even if it is more than 5 years old, 7 years old, 8 years old, without impairing it, and still capitalizing some of the salary cost or interest cost or any other cost. How could management do it and we could accept it? I think this particular clause now will empower the auditor. He will go and say, you cannot, it is all abnormal expense. You can't capitalize under any circumstances. It has to be disclosed. Look at the creditors. I think this is one area which has been ignored for ages, all through. Because none of the auditors, people will look at the provisions to be created for the debtors, if the debtors are old. But nobody will look at the creditors if a creditor was 5 years old, or 6 years old, or 7 year old. No, they said first the management will certify whether the creditors are old or not old. And if you find a creditor which is more than 5 years old or 6 years old, then as an auditor, I will say that I have to look at it. Why this creditor was created at any particular point of time? Why this trade payable is appearing for 5 years or 6 years? I think there are many areas, not one. Believe me, I feel very strengthened. I as an individual feel very strengthened. Look at the cases of even with regard to the related party transactions. I think my independence is assured there, because now I have to comment upon certain things virtually, which I may not have been commenting otherwise with regard to the overdue or something of that sort. So there are still certain pitfalls. Believe me, I've been discussing one of the issues that in the case of NBFCs, I think your guidance also says, no, you have to report even in case of NBFCs, the overdue amount. I don't think if your business is a normal business of advancing the loan, in that case, the overdue amounts have to be given. So I think one is in dialogue with MCA, and whatever MCA will do on those grounds, that's a different matter. But believe me, I personally feel independence is to me, independence of the auditor is the most important aspect of the corporate governance. Independence of the directors is a very, particularly independent director is a very important part of the corporate governance. Now, as an independent director, I think I am the chairman audit committee, I am holding meetings with the auditors as to what they are going to do with the CARO. This is something which is happening. So I am strengthened even as a director, as an independent director, believe me, so far as that particular part is concerned. If I'm going to come out with the ratios and I'm going to certify those ratios, naturally I will like to have a look at it. Why the current ratio has improved? Whether the current ratio has improved because the debtors are piled up or the stocks are piled up, or it is genuinely which has actually improved as a consequence of this. So I personally feel my independence is improved as a consequence of this, and I feel empowered with these particular changes. I don't feel weakened under any circumstances, as either as an auditor or as a director. So I welcome all these changes. Of course, I have been a part of that committee, so I will never. But yes, there are certain changes which I now sit down and find that probably we could have fine-tuned those changes also, and for which the institute, I may even come back to you and say that you represent with the MCA and get those changes incorporated. So that's a different matter. Thank you very much. You are on mute.
So thank you very much. And I think the final summary was that, yes, CARO will enable the auditor to become more independent. And I think Schedule 3 and the need to audit per CARO would also have to ensure that managements will demonstrate their independence more clearly.
Yeah.
Whether it's by way of your Schedule 3 or whether by way of supporting the CARO actions in audit.
I will give one more example, Sripriya, if you permit me. You see, there is a very specific question. If the auditors have resigned, How do you
Correct.
look at it as
Yes.
an auditor?
We've got
Earlier,
questions.
I will say, yes, he has resigned, or I will not even comment upon it. Now there is a very specific question on CARO. And now even the guidance is being provided as to what is to be done in the case of the resignation by the auditors. And the retiring auditor is also to be held responsible in certain matters if it does not disclose the information properly. I think all these things are going to strengthen the auditors. Believe me. Now, I think you will find some changes very soon, wherein not in CARO, but otherwise in the company law, where probably if the auditor has resigned, if he does not bring out the correct facts and later on it is brought out that there were certain frauds, etc., based upon which he had resigned, I think he is going to be held liable. And he will be held liable under very serious actions, believe me. So I think this is empowering the auditors to come up with the correct statement. What were the managements doing all these particular years and why he had to resign in those cases? I think this is very important.
Yes, sir. And I personally also feel whatever has not come, see, Companies Act is a delegated legislation. So it's a body of rules, regulations, aspects such as CARO, which sort of make this law keep growing. So I think what could not come into the act has now come into CARO, and perforce it's become law to comply. So moving on to the next panelist, which is Mr. Himanshu Krishnadwala. Himanshu ji is from Bombay. Again, a very, very eminent chartered accountant, audits large listed Fortune 500 companies, very, very ready to share his knowledge, part of several study groups of the Institute of Chartered Accountants of India, and his contribution to the huge body of literature that this institute has been both phenomenal and seminal. So over to Mr. Himanshu, and welcome to this panel, Himanshu ji. The other element of corporate governance is accountability. Managements have to be accountable for their decisions to the larger spectrum of stakeholders. Now, similarly is also the issue of auditor accountability. So how do you think CARO talks to this fundamental aspect of accountability, management accountability and auditors accountability?
Yeah, good afternoon and thank you, Shripriya. After having heard MPV and Amarjit Chopra, I mean, a lot of things which I've gathered from the earlier two things. But on this accountability, what I basically understand by accountability is responsibility, because that is something which we more easily understand as to what is the responsibility which the company takes and which the auditors take when they need to report on CARO. Now, let me tell you this, CARO is not something, a lot of our auditors and chartered accountants say, why does the government try to enforce a lot of other things through CARO? I think there are parallels in this. If you look at the RBI, they also have something like a LFRA report, where a lot of extra information is sought by the auditors of those companies. As I have heard recently, IRDA is also trying to come up with something similar for all auditors of insurance companies, some extra information which they need from the auditors of insurance companies. So I think when this 143.11 promulgates CARO, it is not something new. However, when it comes to accountability and responsibility, let me first talk about the auditor's responsibility. Now, auditors clearly will be responsible as to what they are reporting under CARO, but is the time given enough to the auditors to discharge that responsibility? Today, if you look at all the companies where the auditors have to issue CARO reports, and most of the companies, I believe, would be those listed entities who have to rush through their financial statements in 60 days, but everyone says that let me do it in the first 15 days, 30 days or something. Now, is that time enough to enable auditors to discharge their responsibilities? And unfortunately, that is how we have some scenarios like, and I know this is being recorded, but let me tell you a scenario which happens in real life is that only the results really get published on the day of the results of even large companies. And there is a gap of several weeks before a whole CARO report is issued or even a whole set of financial statements is issued to the public or the investors at large. Now, can we do something like in RBI, the LFRA report can be issued after a time gap. There is a time gap of 30 days or 60 days, as I understand, to issue a LFRA report. So can the institute tell MCA that yes, CARO is a very important report, and if you want auditors to be accountable and responsible for it, give a time gap. Maybe the main audit report can be issued when the results are adopted, but CARO has a lot of other information which is not sometimes linked to the financial statements. So can another 30 days be given for issuing a CARO report or something, just as RBI allows something like that? So that is something actually which I believe will improve the accountability and the responsibility of auditors in that sense. And if you look at this CARO 2020, 47 clauses as mentioned, the earlier clauses to be reported were only 21. Assuming that few clauses are not applicable to the companies, you will still have 40 to 45 clauses to be reported by all auditors which are there. And to have an auditor who is accountable or responsible and report with some conviction, I believe he would need some time. And that is something which is not available today. And the regulators will really need to be told that this time is to be made available to have more accountability. When it comes to the management accountability, unfortunately, they always come up and say, oh, CARO is the auditor's report. We have nothing to do about it. Now, it is time that the audit committees realize, and as rightly said by Mr. Amarjit Chopra, that he has a discussion with the auditors on the CARO clauses, how they are implementing. But in most of the cases, the management and the audit committee do not really take cognizance of their accountability when it comes to reporting under CARO. I believe they will equally have to tell the management, the CFO, that please gather all the information which is required for CARO, because the auditor is not going to be able to do it himself. He would need support clearly from the company to do all that. And I think time has gone when in the past you had something like a report saying that as informed to me by the management, this is what I am reporting. And FRRB has clearly said that that is not discharging the responsibility as an auditor. I'm sure, let us see what comes up in the reports which are there. I'm sure there would be some such things will also come up as represented by the management, and to the best of our ability and to the best of the information which we have got, I report this. Now, I think that is shirking your accountability. If you are want to give accountability, I think the institute should right away tell that please avoid all such phrases which are there. Otherwise, you are shirking your accountability and the responsibility which is there. At the same time, help the auditors by giving them some extra time. I believe the guidance note on CARO is now under revision, or an updated guidance note will come, which they would like to link up with the changes in Schedule 3. Again, I believe this was something which should have been far earlier, because by the time the revised updated thing comes, I believe most of the reports would have already been issued in that sense. So, and there are, say, if you look at two main clauses of this CARO 2020, Clause 3 and Clause 9. Clause 3 is on loans and advances which are given, and Clause 9 is on loans advances which are taken. Each one of them has 6 sub-clauses. If I take these 12 clauses, I think half of your time for CARO 2020 will be taken up by only these 12 clauses which are there out of 47. And that is where the management of the company, the audit committee of the company has to be clearly involved. Because today the auditor is clearly not able to, in spite of the guidance note, not able to come up with how will I report this. And NBFCs are also covered in a lot of these clauses. And to give a list of defaulters in NBFCs, it could be a list of 10,000 items, 20,000 items. I mean, there is no guidance clearly available. Do I need to give a list? Do I need to give a category-wise things? So to have accountability of auditors, I believe they need clear guidance. Otherwise, they will not act with conviction. They will go about saying that to the best of my knowledge as represented and such things which are there as such. And maybe the institute should come up with some specific workshops or a specific group where a query can be raised before the group on how this CARO issues can be resolved. Just as for a bank audit, you have a group to answer queries. I believe that even for answering this or how do you report on this CARO 2020, there should be a group formed which can inform the members, guide the members as to what should be done or something. It could be region-wise, could be branch-wise or whatever. But to have better accountability, responsibility, I believe the institute also should be playing a much bigger role, and the auditors, I'm sure, will take up that responsibility and that accountability which is expected out of them.
Thank you, Himanshuji. So coming back to your specific point on CARO taking time, I have a slightly, while I broadly concur, I have a small point of view here. See, one is an auditor for a whole year. Now, there are static aspects of CARO and dynamic aspects of CARO. Dynamic ones are those that are linked to your financial statement balances. Now, whether there is an internal audit system in place, whether I'm getting my reports on time. So if you look at almost half of CARO, or more than half, I think 70% of CARO are more control statements. They relate to period end balances. So in that sense, and I think the entire audit process today seems to be hinging on CARO. So if you issue an auditor's report without finishing CARO, because I think all the devil is now sitting in CARO. So I don't know how somebody would look to this delayed or deferring the CARO reporting, but yeah, but certainly a point worthy of consideration, definitely.
No, but Shripriya, the only response is that even for a bank, all the points which are in LFAR are also continuing points. They are not really coming up only at the end of the year.
What will you do if you come across a material weakness in CARO, sir, after you've issued the audit report?
So I believe that let us leave it to the auditor concerned as to whether he wants to issue the report straight away or he wants to wait for those 30 days or whatever is allowed.
But
so
I don't know whether this quarter tak really helps the country, or should we have? But I think it's like this rolling thing. The markets have to move, the reports have to come, the markets have to move. So
maybe Shripriya, before you just move on to the next panelist, I just wanted to take some input on Himanshu sir's viewpoint on CARO coming subsequent to the results which are being published. If you look at the number of clauses, most of them are relating to compliances relating to the Companies Act, be it in investments or loans for that matter, 185, 186 compliances, whistleblower matters, right? And some of these matters are very critical, as you may end up in a situation you will qualify the auditor's report on the financial statements or on the internal financial controls. So if we start giving this report on separately, so the investor may not know. For example, there are loans which are prejudicial to the interests of the company. You might end up qualifying the main auditor's report. So therefore, it may get into a situation where we will issue a report, but then our reports in the market will be a wrong report. So ideally, it has to go on. I completely understand Himanshu sir's viewpoint, because when we audit some of the subsidiary companies where they give only the press release, the CARO is not there. So we have to say that we need the CARO, because without CARO, we cannot go back and do the consolidated audit as well. So I agree there is a problem, but we will end up issuing a report to the market which may be different from what we would have thought. Sorry, Amarjit Chopra ji.
No.
Thanks. Yes, sir. Yes, sir. Please go ahead.
The point which has been raised by Himanshu is very valid, but at the same time, we need to acknowledge one fact. In the case of the banks, the long form audit report by central auditors is compiled from the various long form audit reports being submitted by the branch auditors who are appointed. Take this particular year. The appointment letters have come in the month of April, in the first week of April, for that matter. So I think we may not be able to compare it exactly with the long form audit report. That's the point I wanted to make up.
No, Amarjit ji, private sector banks have no branch auditors concept, but they still have the time for a long.
I don't want to get into that particular debate, whether there is a need or there is no need. I don't want to get into that particular debate. But at the same time, because if we have got about 12 public sector banks today, the reports in respect thereof, if at all, have to be compiled by the various central auditors. These are being compiled from the reports of the branch auditors also, and very important information flows from there, very frankly. Now, there the branch auditor gets hardly any time, and he is appointed either in the last week of March or in the first week of April. So I think this may not be comparable, whereas I said to begin with, I appreciate your point, but probably the comparison may not be possible.
Fair enough.
Yeah. So over to the next panelist, C.S. Srinivas Joshi, past council member, specializes in corporate laws and audit, and very, very eminent resource person in the west of India, very well known even as a national speaker, and unfortunately not had the privilege of working with him in the council, but have heard extremely positive accolades from the rest of the members of the council. Welcome, Srinivas ji. And suddenly the CSR seems to be the buzzword, corporate social responsibility, and I will also integrate it with a general responsibility of the management. So social responsibility is also a big element of corporate governance. And what started slowly, simply as, please contribute to CSR under 135, then became contribute and report. Then now it says if you don't contribute, there is. So we've seen a slow progression from becoming a soft law to a very stringent law now with audit requirements, CSR1, CSR2. People are talking of CSR audits. So effectiveness of implementation reviews. So what are your views on CARO and how would it strengthen management responsibility and management social responsibility?
Thank you, Shri Priya, and honored to be with such a eminent panel. Especially, I don't think I am eligible to sit next to Amarjit Chopra, Himanshu, and Bhaskar, but you made it possible. So thank you very much. Coming to some points which have already been discussed, I'd like to add to that without repeating them, some of them. Abhayji said it is about absolute assurance. I personally feel if you see CARO, and this is also for Amarjit sir to respond later after I complete, the ASA 700 reports says it is a reasonable assurance, and CARO is a part of that report. If you really see the whole structure of the audit report. Now coming to that, whether it is a reasonable assurance or absolute assurance, for information required, obviously it is absolute assurance that when I'm giving some information on a date or something, but otherwise I think reasonable assurance should be okay, number one. Number two, when you read CARO guidance note, which was issued long time back, CARO 2020, in June 20. Now here we have discussed about materiality and said that all CARO points should be on materiality. But when we knew CARO is not being implemented 2020 because Schedule 3 has to change first. They are asking us to report on something for which their management is not responsible of reporting. Now, since they have deferred CARO 2020 and synced with Schedule 3 was actually, now it is absolutely in sync with CARO 2020. Coming to that, Schedule 3 does not talk of materiality. It talks of the absolute, like Abhay said, of absolute assurance. Now, coming to this, since I was chairman of CLCGC last year, we have noted down some points, and even in the council discussions, that one of the point was that we should write to the MCA on one is on materiality aspect, and second is on comparatives of the previous year. Shouldn't be there for the very first year transitional programs. So these materiality aspect, I think we can still take up with like CARO 2020, if it is on materiality, then Schedule 3 also, management also should be allowed to go on materiality. It's a question. So reasonable assurance versus absolute and materiality, I'll request Amarjit later on, Amarjit sir to talk about. But coming to the, of course, the materiality cannot be there when there is a regulatory information required. I fully agree. Coming to the other point, there was a request from ministry last year that we have want LFAR similar to LFAR, something for the companies. Then the response is on record when I was the chairman that we said that either there can be CARO or LFAR. You can't have both because both LFAR will be much detailed, whatever you want to say, like in case of banks. So we suggested also points in LFAR, but we said both cannot exist simultaneously. Again, the views of the panelists can be given on this point as well. Coming to the necessity of CARO 2020 and Schedule 3 amendments, whatever we call, or whether we call it a surgical strike, finally, I think such changes were needed. Amarjit sir rightly explained the CWIP, how CWIP needs actually no capitalization, or it's never to be will be capitalized, it's just getting added, some expenditure is being shifted, or the projects have become defunct. I mean, they will never see the light of the day and needs a write-off. Now, this kind of thing will be highlighted even for the auditor in Schedule 3. But other thing, if you look at CARO has now asked for, say, intangible assets. You know, a lot of things will come in Schedule 3 and also in CARO. Now, here the guidance for talks of record of register, license registered, like a record of litigation, impairment of such intangible assets, etc., and appropriateness of capitalization write-offs. Now, this will be more looked into, more in depth by the auditor, and therefore such things were needed. I think some of the industries like IT this asset will be far more important than the tangible assets. And therefore, I think this was a good move on the part of the government to include all this in Schedule 3 and CARO. Coming to your question on responsibility and social responsibility. First responsibility is responsibility to govern. And responsibility to govern is like we keep on talking on corporate governance, which is a responsibility of the good corporate governance, the responsibility of the company. Now, coming to that, what is corporate governance? It says, the definition says it aims at independent and objective decision making by the board, transparency in procedure and practices, and appropriately monitoring the functioning of the management. And if you see, the company law itself has provided several things for such kind of governance to be done. For example, there's a one woman director, or if you say chairman of the nomination remuneration committee has to be an independent director, or there is a performance evaluation of the board, performance evaluation of the independent director, separate meeting of board of directors, whistleblower mechanism, related parties to be passed by the audit committee, etc. And there are several. You can keep on adding the big list of board committees, directors, pecuniary interests, and so on. So what the law tried to do. Now what they are trying to say is that let somebody say that this was appropriate. There was a corporate governance report, but in spite of best of the corporate governance, as Chopraji said, that the awards were given, and thereafter, suppose the government, some company fails in 3 months of getting a corporate governance award. I think there was a concern with the government. Coming to the CSR, what is actually expected in the corporate as a corporate social responsibility? If you see, the companies need, it is said about CSR is what companies need to do is they need to be conscious of the kind of impact their activities are having on the economy, on economic front, social front, environmental front, and obviously governance front. So they need to be conscious of these impacts, and therefore ESG, which was discussed heavily in our previous CLCGC group meetings like this, was this framework, how it impacts sustainability and ethical practices were discussed heavily. This particular CARO and Schedule 3 now requires us to give on CSR. I think what CSR by all the corporate sector is directing itself to ESG, that what environmental, on renewable energy or waste management, how they are handling the air pollution or water pollution, or how they are handling the climate issues, deforestation, etc., is well described there through CSR. CSR is one way of spending for looking at all this, and without, of course, CSR also many companies would be doing on this front. About the governance issue, as I said, there's a fiduciary relationship whether the board is having for the relationship and about all the stakeholders, whether they're taking care of all these difficult their responsibility is not only CSR or not only ESG front, but their responsibility is to see that all the stakeholders' interests are properly protected, even though they are conflicting interests. And therefore this is a big governance issue for the board always, to be transparent and all. So I think that I hope gives several issues for other panelists to react on. Thank you.
Thank you, sir. Thanks. And last but certainly not the least, invite Mr. Bhaskar Panneerselvan. He's from Chennai. Again, a very eminent chartered accountant, extremely well-read, and a very accomplished professional. So welcome, Bhaskar. And the other element, or perhaps the last element of corporate governance that we're talking about here is discipline. Your views on why CARO came in? Is it going to improve discipline, or is it like, virtually pushing discipline, the need to discipline down somebody's throat? I mean, what are your views on this?
Yeah. So thank you, Shripriya. Good afternoon to all. Good afternoon, MPV sir, Amarjit Chopra ji, and good afternoon to other panel members as well, and good afternoon to all our members as well. So the reason I think the CARO 2020 has come, MPV sir has rightly put out, saying that there seems to be an expectation gap in terms of what the outside stakeholders are looking for and what we are giving. Okay, so therefore they seem to be wanting more, and therefore requesting who's the person who can give that comfort on that. It's the auditors who's going to give that. So therefore they are putting out to the auditors. But personally, if you ask me, you want me to sign up on 47 clauses, clause by clause, put my name and membership to that? I would personally say no, right? Because let's look at what is happening across the world how the auditors are signing up in terms of they are signing off a 1 or 2 pages report. That's it. We have been asked to sign up on the full paged SA 700, 705 reports along with CAM for specific companies. We have been asked to sign up on the IFC report. For NBFC, certain additional reporting which we have been asked to sign up. Finally, on the CARO of 47 clauses. There's so much of responsibility on the auditor. So personally, as an individual, I would not want. But having said that, does it improve the right of the auditor and also improve the corporate governance? Answer is clearly, as Amarjit Chopra ji had told, it improves the right of the auditors. Go and talk to the client and say that these are the matters which I have to audit it and give it in the report. If you're not going to give those informations to me, I am going to put out in the report. So therefore, it improves the discipline element of it to make sure the client complies with all the matters which are set out in the CARO. And it anyway helps in for you to kind of give your opinion on the financial statements. Let me take some specific examples where it will be kind of looking at it. For example, the loans. So earlier, CARO talked about loans to related parties, right? 185, 186, and 189 parties. Now it is to all parties. So any investments made, any securities given, any guarantees given, right? Any loans made to any parties. It can be your employees, it can be any parties, right? You have to comment whether it is prejudicial to the interest of the company, whether it is recoverable, it has been recovered on time. So that is the biggest number. Sometimes it sits on the balance sheet, right? So therefore, a lot of investments you make in certain companies, and after 2-3 years, you go and write off that, right? So who can be held responsible for that? So therefore, it puts discipline on the management as well as the auditor to make sure that you audit that properly and give a comfort on that. So that's one discipline which gives in terms of what to do it. The second one in terms of the entire reporting to the reporting on the bank for the information submitted to the bankers, right? So while the listed companies, large companies do have the quarterly closing, so therefore their accounts are closed properly, and you tie up to the information which are given to the bankers. Look at what could happen to unlisted companies, right? So where they don't close their books till the year end comes, right? And they give some statements to the bankers, an estimated statement of a stock statement or an receivable statement. There's nobody who's going to tie up to those financials. They close the book on a year-end basis, and they book all that or whatever the expenses, revenues, provisions, which they do it at the year-end, and the quarterly numbers are not there. So what this CARO does is put a discipline, saying that you do your book closure properly, appropriately on a quarterly basis, make sure they tie out that number. So therefore, a set of discipline even for the management to kind of do with the preparing the financial statements. The last one in terms of the fixed assets, for example, on the capital work in progress, which we talked about, is on disclosing the aging of the capital work in progress, which helps the auditor as well as the audit to make sure that the impaired intangibles or fixed assets are not getting carried forward. The more important aspect is on the discipline on the operating management. So you are going to report on whether the projects are exceeded the time, projects are exceeded the cost, right? So if you are going to report that in a financial statement to an external world, it puts a discipline requirement from the operating management to make sure that they complete the project on time, right? Or they kind of give a proper explanations to that. So these are some of the matters, not only kind of improves the corporate governance element of it, but also improves the discipline within the organization. So I think it's a good one from an auditor's perspective to make sure that the management complies with that. So that's my take on that, Shripriya.
Thanks. And I think possibly the most hurting thing that CARO will correct is this variance in stock and book debts reporting. That when it couples itself with the audit trails, which they have fortunately or unfortunately, I don't know what's more appropriate, deferred by a year, I think it's fairly good. But it also hurts in some way because these things have been happening, and it's been happening so rampantly that some authority had to come and actually put out an audit checklist. In fact, one thing that I keep thinking about is if you look at the entire audit process that you do, it's all come now in various segments. So maybe the government should just come up with one form 3Z, 3CZ or something like that, and say, you please fill this up and say it's true and correct. It might just become simpler for us rather than to have so many audit reports you have an IFC, you have the main audit report, you have CARO, and then you have the notes to accounts, P&L, balance sheet, cash flow. I don't understand whether any banker is able to read all this, in sync. It's very, very difficult. So maybe there would also be a phase of a clarity project or a simplification project, more English. So, yeah. So happy to let you know that we finished with part 1, which was the preliminary remarks. And I think we are only 5 minutes behind schedule.
No, Sri, only one thing. I think Srinivas had raised certain issues which we need to answer. He said that he would like to have our reactions on that.
Sure, sir. So these are most of what he has mentioned.
We must answer those. Number one, he raised the issue of materiality and the other part. I think Institute would be 100% justified in going to the MC and say that probably except for the situations where the facts and figures have to be actually attested, in the other matters, materiality level should be brought in play. There is no doubt about it. And I think Institute should do that as fast as possible. The second thing that I will like to say is that he talked of MCA asking for a long form audit report, even in the case of the company's audit. Though, very frankly, sitting in one of the committees of the government, one has been able to persuade that probably it may be too much of reporting, if you really ask me. But if you have to draw a parallel to this, you can draw a parallel in the case of the PSUs. The auditors are still giving another report. Very frankly, in the case of PSUs, besides giving the main report and the CARO for that matter. So it is not that there is no parallel to this. There is another parallel to this. But I think over-reporting may not be justified, and particularly here now with all the kind of questions which have come in 2020 CARO, I think certain things can be avoided, and long-form audit report in that particular format could be one of those things. So I personally felt that I should, so far as CSR is concerned, I will like to say why the government wants it to be done. I think that is one very important issue. Companies have created their own trusts and they transfer the amount to the trust and say that the CSR has been complied with. This is absolutely ridiculous if you ask me. The companies may transfer their funds to the trust, but then the company which has transferred their funds, they must ensure that that project has been undertaken which the trust had actually proposed. But that is not happening. That is where the CSR funds are being misutilized. If you really ask me, one of the greatest challenges that the Institute would face in the times to come is how the monitoring of the CSR funds was done. Mark my words today, after another 5 years, probably the same government would come up with asking you, how did you actually monitor the fund utilization of the CSR fund? Because that's not happening. The auditors are not bothered. The auditors feel that the amount has been transferred to a trust or someone else, the matter is achieved. And these funds will be most of the time misused by the political people also. I can tell you that also. Because if you read the guidelines, it says preferably it should be in the local area where you are located. But anyone coming to you and saying, no, I want it to be transferred to my constituency and being served there. No, whether it happens there, it doesn't happen there, nobody knows. But the funds are transferred, mark my words. And particularly, I'm cautioning all the auditors where the amounts are being diverted to the trust of the same company. How do you ensure the utilization thereof? And you should be. And suppose there are instances where the same company, the trust has returned back the funds after some time. These are also the cases, saying that these are remaining unutilized. I'm actually surprised how it can happen. So probably as directors also, as auditors also, we will have to take care of the situations like this in the times to come. But I am very clear on one point, after 5 years, this will be one area on which auditors will be getting a lot of flack if we don't wake up now. That is what I would like to say.
Maybe Shripriya, maybe just to add Sir's point, I completely agree with that. You would have seen a lot of press release. Government is indicating that they are going to do a CSR audit or a social audit and all into this expenditure which are incurred. And this is one law or this one section where the penalty provisions are very strong. where even if there is a delay, you don't have a choice but to deposit a 1 crore amount or whatever the amount involved, whichever is less. So this is one of the significant provisions, and therefore we not only the amount which we contribute, which you have to test, but also the utilization of it. Because if they don't utilize it, it is the obligation on the company to get back the money, keep it in a separate CSR account till the money is being spent. And I think, sir, you have brought out a very valid point. And if you are going to get into trouble for any of those matters in the next 4-5 years, it's going to be on the CSR matter. So I think we need to up our antenna on the CSR element of it.
Shripriya,
You're on mute.
Thank you, Bhaskar. And as we speak, we are actually trying to do these modular courses to bring up chartered accountants. But the other thing that I think will also happen with this CARO and things like that coming in is, just as how it spawned off IFC as a professional opportunity, there will be a need to engage specific auditors even for CARO and CSR and things like that. And maybe the market will just kind of move up. And I can see Mr. MPV being a little skeptical about it, but you know, from an institute perspective, yes, I think we need to engage our fraternity members.
You need to find any opportunity.
Yes.
No, I smiled because I thought it was already a responsibility and not a new opportunity.
We're going to have a larger base of people doing it, and I think it's important.
Even if you take IFC, Shripriya, my view SA 315 was there. You just required IFC to tell that yes, I'm doing it. So my view, I was supposed to do it. Because I didn't do, it became a separate thing. You know, I think we have to come out of that situation. In any case, different conversation.
Did it. Even the US didn't do it, which is why SOX came. And then
it's a different. It's a different conversation. We'll have it done.
Yes, even here, I would like to add on here, because of this matter is going on for discussion. There is one new opportunity as regards to ESG rating also is coming up on this CSR. So that is environment, social and governance. And recently we have also represented to SEBI about why not the chartered accountants should also be involved in for this ESG rating. So let us hope for the positive, and a lot of things are going on the sustainability front also, in which also the CSR activities and the social development goals and all are going on. That's all. Over to Shripriya.
Sure. Thanks, Preeti. I'm sure we'll all get better over a period of time. The first question is to Mr. Bhaskar Paneerselvam. So do you think the new Schedule 3 and CARO transform financial reporting to management reporting? I have a set of about 15-20 questions that a couple of people wanted asked, so I'd like to run them. So I'd be very happy if you can keep your response a bit short, maybe 2.5 minutes. Does it transform financial to management reporting?
I won't take that much of time. Actually, it's a management reporting. The way Schedule 3 has been amended to include receivables aging with 1, 2, 3 years, right? Disputed, undisputed. Undisputed, CWP aging, and also project completed or not. Payables, sir talked about aging in terms of 1 to 2 years, 2 to 3 years, etc. And ratios, for example, you have ratios and you have to give an explanation for ratios which are exceeding 25% compared to the previous years in terms of the variant. So I think there are so much of information which needs to be given in the financial statements, which we would have not thought about it, whether it has to be carried in financial statements. So the objective seems to be where whatever the management has, for them to make a decision whether the investor should also get those information. That's the objective. So you can't hide certain information which are so critical. For example, on receivables, capital work in progress, biggest items in the balance sheet. So the government wanted to put that openly to the others. What the management is seeing, let the investors also seeing. So put the responsibility on the management. Therefore, it is moving towards a larger disclosure items. And one way it's good because the management will be forced to make sure that these are properly handled from an not only on the financial statements perspective, from operational aspects also, so that it goes to the outside world. So if you put out a receivable saying greater than 2 years and you said you are not provided for, right? So there will be a question from the investor saying that why you are not provided for. Similarly, sir said 5 years received payables is there. Why you have to keep that payable? For what reason? Is it a deposit or something else? Right? So all those questions will start coming in. Yes, it's moving towards more of a management reporting, in my view.
So just to take on from where he left, and this is for Mr. MP Vijay Kumar. So again, the government's going to get a lot of information, and not for all filings are in XBRL. It's only a select list of companies. Do you think this whole thing, the goals would have been better achieved by having an annual information return, or not to embed it as part of your NGT 7 or AOC 4, than making it an audit checklist? Who's going to get all this data? Who's going to review all this data?
No, I say, as far as Schedule 3 and CARO is concerned, the information is going to be available to all the stakeholders of the general purpose financial statements, which includes the investor community, the lenders, and taxation authorities, regulator. I think all of them will have access to the information. I don't think a portion of it is getting held back, except that in Schedule 3, some of the information which is not directly linked to financial numbers, we have moved it to a section called additional regulatory information. We have moved it to that, but they will all still part of the annual report. I think what is important, Sripriya, is it's a transition phase in my view. I think it's important to gain the confidence of all stakeholders that businesses are being managed properly, and audit certificates can be relied upon blindly. You have to get to that state. It's a journey. It may take 5 years, it may take 10 years, but it is a journey. In the interim, I think it's important to have this bit of transparency because when it comes to receivables, it will help the investors, lenders, all of them to get their understanding of whether they want to be part of that company or not. So the idea is to make it available to them. So in fact, while Bhaskar said it's management reporting, I don't want to take it off into that route. My view, the idea was to empower the investors to take an informed decision that here is a company which successively has receivables of this profile, payables for long. Let them take an informed decision. There can be still some investor who may say, I'm okay with it. And he is willing to take the risk. But the idea is to make that information available. I'll just take 1 extra minute and you can cut off one question for me later, maybe in terms of time management. I keep saying this and I keep coming across many people say that, particularly the audit fraternity say that there is an overload in terms of reporting requirements and audit requirements and things like that. But let's understand the purpose of our existence is for the users of financial statements. We are existing essentially for users of financial statements. If the users of financial statements, who is our consumer, is not getting what he wants, our relevance itself becomes a question mark. So it's important for us to continuously engage with the users and ensure that either their expectations are set right or we are going there. And I just want to quote from each of these three. One is from Framework for Preparation of Financial Statements, Framework for Audit, and in the context of MCA, I gave you that mission of MCA. If you look at the Framework for Accounting Standards or Audit Standards, both of them very clearly provide that the purpose of standards is for the user's benefit. It is never intended. It is never intended for the preparers or the auditors. Never intended. So anytime I do standard setting, the idea is user. Is he benefiting from it? I think that's the objective. And as auditors who are more involved in the financial statement process, the moment we start looking at it from the user's perspective, then the way we will start reporting, the way we'll start auditing will also change a lot. Because, pardon me, within this forum, I know it's a recorded session. At times, I come across some conversations saying that it exposes the organization and things like that. That doesn't matter. My objective is not about whether the organization is getting exposed. My argument is it something which the user is supposed to know? If he's supposed to know, I should provide it. That's my bottom line on this.
Sure. Sure. And just maybe, and this is a question that I'm going to club for Mr. Himanshu's next question, and then I'll come to Mr. Chopra and Mr. Srinivas after this. See, you talk about users, and since there was a reference to IBC, I would like to bring this on record. There's a very famous Tamil saying that says, I opened my bookstore, but nobody came to buy a book. So today, even if you look at our own audit reports, when we talk about IBC failures, look, there is in 2017, a 50 crore of inventory sitting there. Account has become an NPA. We're now talking in 2022. Do you think, first of all, the ecosystem, and I'm largely talking about the banks, I'm not talking about those well-educated research analysts, investor community, etc. Do they have the bandwidth to assume, to absorb all that we are writing in an audit report, one? And two, do you think more information overload is going to be helpful? And three, what do you think as an institute we should do? Should we do training programs with bankers to help them to understand how to read financial information? This is for Himanshu, sir, and after which I also go to Srinivas, sir.
Yeah, so Shripriya, I think MPV just said that the CARO report and this additional information is for the users, but as I personally believe, this is all more for the regulators, because if I see the language which is used in CARO, in some places they have used, please report whether the funds have been diverted. Please report whether this is done. Please report whether this earlier auditor's designation reasons have been considered or something. I believe the regulators are wanting all that information so that they can start taking action. Otherwise, why would they use the word something like diverted? Let the facts be come out. Why should an auditor report whether things are diverted or not diverted? Because the businessman would say that I used the funds for a particular purpose. It necessarily does not mean it is diverted. The auditor just reports on the facts in that sense. And from that angle, what you also say is right, that this audit report, especially CARO, has become more of a proprietary audit now, because now I'm supposed to go behind the logic of why the business is done. Now, let me give you an extreme example, which I give in a lot of my sessions. There is a company and it has a lot of cash, which it has earned from maybe its operations or something. And the board of directors and the audit committee resolve, and this is an extreme example, that, okay, I've got 10 lakhs of cash, which I would just like and dump it into the Arabian Sea. Because this is a business decision which I want to take, or a decision, I have a lot of cash, I don't know what to do with it, I'll just go and dump it into the Arabian Sea. Can an auditor question that? If a proper appropriate approval is taken by the audit committee and the board on that, that's a proprietary issue. It is obviously something which is not logical, which no one would agree, but can an auditor object to it? And that is the fine line of distinction I always like to draw as to, can an auditor get into business decisions? And CARO 2020 and Schedule 3, by asking a lot of that information, which is more MIS or management oriented, is getting into the proprietary of things which are there. So whether is a management acting right or wrong? Is the auditor supposed to comment on whether the management is acting right or wrong, whether he has invested in a subsidiary? If the subsidiary ultimately does not succeed, how is the auditor concerned about it? He will only see whether the approvals are taken, whether the due process has been followed. So I think that thin line of distinction is something which is getting blurred now as to what is the management's role and what is the auditor's role in that sense. And this CARO has also put the auditor in trying to project something into the future. All along, it was always reporting on the past activities of the company. Now it is also like saying that go into the future and forecast whether the company will keep on running as it has been doing in the next 12 months or something. In fact, I also tell in a lot of sessions that in our audit teams, we will now have to include some Jyotishis also, because only they can predict whether company will run in the future or not. So, I mean, this is something which I would believe the institute will have to come up with something to draw this fine line of distinction between what is management's role and what is the auditor's role in the whole thing.
Yes, sir. And in this, I think later is better. The later you sign your financial statements, the more comfort you have, because at least some amount of money would have come back. And so the tests of subsequent payments, subsequent realizations, I mean, it's just a point of view, and it's obviously intended on a lighter vein. So Because I do agree with you. I mean, the CARO has sort of tilted it more from true and fair to a proprietary audit. And what's more scary is it sets the expectation gap even wider.
Correct.
And the CARO is also slightly complicatedly worded. It's not simple. So there is a lot of meaning that one can read out of the new Schedule 3 and the new CARO. And the next question is,
Cypriya, if I can, sorry for interrupting, if I can.
Yes, sir, please do.
I just want, since it's an institute platform, I'd just like to share that as far as CARO or Schedule 3 are concerned, the idea is to get some indicators on governance, indicators on behavior of an organization. I think that is what the users want to know. So when you're discussing about related party information and all, you're actually giving indicators so that let the investors take a call. And for regulators, if they want information, there are several ways to get the information. But the idea here is to put the banks who are lending, the investors who are participating on alert, saying that here are these indicators, just watch out. Just watch out. If you want to go probe further, go probe further. So I don't want it to be taken to a different route. I have very high respect for Himanshu. I've been a great fan of his. I've been a great fan of his and vast level of knowledge. But being part of the institute platform and having seen the evolution of these two documents, I want to very categorically put for all the stakeholders who are listening to us here that these are done with the intent of identifying as many lead indicators or red flags for the users of the financial information. That's how I see it. And I sincerely wish at some point of time, CARO gets shrunk or it disappears. That will be the day that we would have all contributed to enhanced governance and confidence of investors in the audit fraternity. That's how I look at it. Sorry, Himanshu bhai, for interrupting.
No, absolutely fine.
And I think just to add to what he said in a very small line, why would a regulator do it? The ultimate objective is to protect the stakeholder. So otherwise, there is no role for a ministry there. So whatever they do it for either ease of doing business or improved governance or cost of compliance. So I think there's a story to it. The next is to Mr. Srinivas. There's suddenly a lot of emphasis on title deeds. So again, CARO requires disclosure now. I mean, were we a land of that great a mismatch between what was supposed to be owned by the company and what was actually owned?
Hello.
Yes, sir, we can hear you.
Yeah. I think there's nothing new in what has come in. If you see all the, if you 143.1 or whatever previous CARO 2016, everywhere there was no mention of these title dates being checked. Title dates, fortunately, genuineness of title dates can never be seen by a chartered accountant. It is not his review. But now it is said at least whether they are in the name of the company has to state, and also the auditor has to state. But if you look at company law, section 187 already says that all property, security, or any other asset, if it has to be in the name of the company, otherwise there is a penal 5 lakhs rupees penalty. Now, if you really see, this was already there. Now, auditors were probably knowing that it is not in the name of company, but not revealing. Now, if you see the clause, what is required to be given, I'll highlight only few things, that whether promoter, director, or relative or employees are holding this asset. This is significant from what MPV said, that the reader understands what is happening in the company. Period for which it is held. So suppose this owner is holding it for 5 years, 10 years and not transferring it to company, those who are holding employees or whosoever, promoter, director, has a meaning in there. Now, if you really see the two more questions, what is the reason for not being held in the name of the company and indicate the dispute? Now, here the thing is, I think what is stated there is to be read. Now, I feel the purpose of this particular requirement is that the use of company's funds is being made without corresponding benefit being accruing to the company. What can happen is a person holding this title can even sell, mortgage, encumber, or may not account for all the considerations which are attached to the property. He may not do it. Another side, he may overvalue or undervalue. Overvalue when he is selling, or undervalue when he is, overvalue when he is buying and undervalue when he is selling. And there is no guarantee that all the benefits will accrue to the company. That's why they have been saying what is the reason, what is the dispute, what can be done is, there is one more section I like everybody to understand, section 192, which talks of non-cash transaction with directors. What I can do is I take a property where I create a dispute. They have asked whether there is a dispute and how many years. Now you can create a dispute, have a property, have a credit in the loan account and pay off the loan. Now, this is the best way of diverting the funds of the company without actually buying anything from out. We just create a dispute. Now, dispute can be created, in agriculture, everywhere, a relative can create a dispute of a person who is trying to sell. So, it is all stage managed. So, this is, I think, the effort to see that, first of all, this is a fund of the company are properly being used by the company for and buying the asset. And obviously, if the question is not there, but I feel that whether such asset was at all required. Now, Chopra sir said that we go beyond, everywhere in audits, we go beyond to whatever we know. Whether this dispute, this is just a diversion of funds, just outside and saying that this is disputed, it will come later on. But is it useful to the company? Whether it there's no question on that. But I personally feel that all this diversion of funds in all frauds we see, there's a huge diversion of funds outside the company in many ways. And especially outside the country, most of the amount is going. Now, this is one way, is a title deeds not being there. You just pay off the money, either make a journal entry and then pay off, or just show it as purchase, pay it off, and money is just diverted for other uses. And never the property never comes or never used probably. So I think this is a very important clause, and the use of fund of the company can now properly tracked in this case.
Thank you, sir. Thank you. And over to Mr. Bhaskar now. Inventory verification, inventory variances, 10%, category-wise reporting, 5 top safeguards. What should the auditor do? Be there, and inventory as certified by management. All these are some random clauses that I've just thrown at you. So if you can say something to make meaning out of this.
So first of all, I'm a significant non-believer to say that inventory is as certified by the management. I don't know then what I am being entrusted with as a responsibility as an auditor, or that for that matter do the physical verification of it. So it's a fundamental duty of an auditor to make sure that you observe the count which is carried out by the management, and also you have a fundamental duty to verify the valuation of the inventory. So therefore, the fact that the company includes or the auditor includes in any of those matters, stating that the inventory is as certified the management, it's not going to help the auditor before the regulator or before the stakeholders or even for somebody reading the financial statements. Actually, it throws very poor on us as an fraternity to say that it is as certified by the management. So we can't take that. We are supposed to do our duty and report on that particular matter. Now, going back to your first question on the 10% threshold, there are first it has to be for this certain class of inventories, specific class of inventories, work in progress, finished goods, raw materials, tools, etc. So you classify that and find out the difference for that particular thing based upon the physical verification carried out by the management, and you have observed it, and report whether the difference is more than 10%. One important element here is that in the CARO 2016, you have to indicate whether the material discrepancies, if any or so, has been appropriately dealt with in the books of accounts. Now the question here is, even if it is not even if it is not material, but if it is more than 10%, you have to report in this particular clause. So that is one important element. The second element is in terms of companies which do have perpetual inventories, right? You have to be cognizant of the fact that you have to aggregate all the differences across the year and identify what is the difference and see whether those 10% is there. Then you have to report on those elements. So therefore, even though sometimes inventory may not be material from the financial statements perspective, but for this specific clause, you may end up observing some of those inventories to make sure that you can report on this difference. So therefore, one is materiality element of it, keeping proper records for the perpetual count, and aggregation of all those items. These are some of those safeguards which I would put it. Also to make sure that the inventory count is not done only at the year end. So which means then if there are significant differences which are there, you will end up reporting as the differences which are greater than 10%. So this is one area for members to kind of look into it from a reporting perspective.
Thank you. And this is for Amarjit, sir. Inventory reporting, stock and book debts has been the biggest area of concern vis-a-vis banking transactions. Do you think the variance reporting, which is now required in CARO, should have been extended for all cases of companies and not only for working capital limits which exceed 5 crores, which is the current threshold?
I personally believe, Sri Priya, what you say may be correct, that it could have been actually extended to all the companies. But then one thought, let's begin with it. You see, if you really ask me, all these thresholds can be reduced or enhanced depending upon the circumstances. And I think this is just the beginning. And probably if people don't report fully well, what may happen, I don't want to comment upon it. But I am very conscious of the fact that people have not been reporting it correctly. And there has been, I will just give you a few examples. Based upon my own experience while conducting certain audits of the bank branches, forget about the other part. And these are the balance sheets which have been certified by the auditors. In one of the cases at the manufacturing company, 33 crore turnover, 3 lakh raw material stock, work in progress 0, and finished goods about 7 lakh. And you think that the company exists or the manufacturing unit exists? I don't want to comment upon it. 33 crore turnover, manufacturing company, 0 work in progress, 3 lakh raw material, 7 lakh finished goods. And if I still believe that the unit probably is existing, I'm living in a fool's paradise. And then the auditor has certified. Another, which is the most classical of the law. The work in progress is almost equivalent to, and it's a 1200 crore limit enjoyed in one branch, mind it. Let's be very clear about it. 1700 crore exposure to the banking industry. In this particular case, the work in progress was almost equivalent to the turnover of the year. And then when one gets into the entire facts, one realizes average sale price of the product is 1200 to 1300 rupees per kg, and the work in progress has been valued at 2300 rupees per kg. As if the bank was only funding the losses. And if still that stock statement is correct, after all, and if that balance sheet is correct, I don't know what to say, basically. I think somewhere or the other we have faulted. I will give you another case. A book debt statement, if I look at the opening value of the debtors from on 1/4/2015, it was 55 crores. The book debt certified on 31st December 2015, 296 crores. The total sale for the year from 1/4/2015 to 31st March 2016, only 205 crores. Can you think of a figure of 296 crore as on 31st December 2015? Even if no amount is realized for the full year, the debtors could have been only to the extent of 260 crores. And how it could be possible? Now 296 crore. So what I'm trying to say is that somewhere or the other, I think we have invited certain clauses on us, basically. It is very nice to say that why should they ask for the diversion of the funds? Diversion of funds has not been asked for anyone else. After all, bank is also a user. Bank is also a user of the financial statement. They are one of the stakeholders for the financial statements. And if they come to know that their funds have been diverted somewhere else, they will naturally then take cognizance of that particular fact. And similarly, if an auditor has resigned, I think every user of the financial statement has a right to know why the auditor has resigned. He must look at it with some kind of, I think, caution that if an auditor resigns in between, I think it's a matter of concern to any user of the financial statement. So whatever has been asked in CARO, it's not because the government wanted to ask it. I think we invited those questions. Mark my words. I think MICD very rightly said that we need Jyotishis or we need astrologers But then even for the purpose of going concern, we require astrologers for that matter. After all, how will we tell that whether the operations of the unit are going to be closed down in the near future? When I talk of near future, I definitely talk of about 1 year, 2 years, or 3 years. And here, what has been asked in CARO is virtually 1 year period, basically, that you need to base upon your decision whether the current payables will be, the company will be able to make, will be able to settle its liabilities in the next 1 year. I think it is not unreasonable to ask it. Yes, it could be difficult to answer for an auditor. I do, no doubt about it. But probably when I can answer under 570 the question of going concern, in that particular case, I can definitely answer this question also to an extent. To an extent, I'm not saying entirely for that matter. So whatever questions have been asked or whatever questions have been posed to the auditors or to the management, even with regard to going concern, even the management has to answer the same question. The management will have to answer all those questions with regard to the future. So it's not that only I'm going to answer that question. So I think all directors become liable for it.
Yes, sir.
So to that extent, the auditor is drawing some kind of I think, comfort from the statement of the management. Now, when an independent director or an executive director will have to certify this, he's not going to feel very comfortable. Mark my word. When one is going to say that the returns are the same, I have just done one of the meetings, very frankly, with the auditors, where I asked them a very specific question on record, whether the returns which they filed with the banks do agree with the books of accounts or not. And they said, yes, I feel comfortable. And it is a part of the minutes. After all, you see, somewhere or the other, someone will have to draw some kind of a comfort. As an auditor, I will draw comfort from the management, and management will draw comfort from somewhere else. So this is, to my mind, a good thing to happen, but I do go with what Vijay said. I do wish very sincerely that this keeps on shrinking now from onwards. After 5 years, the government itself wakes up and says, now we find the governance levels to be much better, and we can shrink this particular report to an extent. But if they expand it further, then we'll know what is happening. So my humble submission is to the entire profession at large, to the managements, to the companies at large, is please ensure that we do act in a manner now that these reports start shrinking. Because today there is so much of distrust basically on these financial statements. I think that is why it has come in. Otherwise it would have come in. So only one can wish that the future is bright for the profession so that the report shrinks basically. And if we are able to give that assurance to the government, the opportunities will automatically start coming in. That also I can tell you.
Thank you very much. And this one is for Mr. MP Vijay Kumar, and a short answer. We have a dichotomous valuation scene in the country, not because of anything else. We need to wind up at 4. And for this panel, because it went very well, we've decided to take all the questions, and straight away I'm making a request to whoever is available to come for the next panel to answer those specific questions, which will be a very structured Q&A panel alone. So we have a dichotomous valuation scene in India. For one set of IBC cases, etc., the SEBI part of it, we're going with registered valuers. The banks still continue with the normal valuers. No mandates seem to have come yet. Do you think this harmonization should happen? When would you want this to happen, and your views?
My view, it has to happen, Sripriya. I think in terms of timeline, it's a question of how much capacity we are able to build over time, because this will require extensive capacity building across the country, including Tier 2, Tier 3 and all. I think Institute Valuation Standards Board and RVU have been doing good job. So I think we have to give time. I'm not able to put a finger and say 3 years from now. Maybe it's too aggressive a target, but at some point of time it has to happen.
Or maybe we could go up and recommend that for loan values above, let's say 50 crores, you can have to get it done only by a registered valuer. So slowly
50 is a very small number. So I would recommend much larger.
Sir, if you look at CRILC reporting, it's 5 crores. So I'm multiplying it by 10 times. So
Okay. No.
yeah. So the next question is for Mr. Himanshu. Recording of transactions. I'm sure you do a lot of practice on the tax side as well. So recording of transactions which have been surrendered as income. Do you think there was a large problem that existed? Parallel sets of things happening with income tax. Now it's an attempt to integrate. Your views?
Yeah, this is a new requirement which has come, and it is also there in the Schedule 3. So the companies are also supposed to report all such undisclosed income. Now, unfortunately, the question which is there has no linkage directly to any section of the Income Tax Act, which really defines undisclosed income or something. The guidance note, however, has said that please restrict the definition of undisclosed income to what is given in that section 158. And though a lot of us don't directly practice in that sense on the search and seizure, this has forced us to look at the search and seizure provisions of income tax in that sense. So if there is a search or a seizure and there is a forced declaration which is taken and the SSE or the company pays tax on that particular portion, the company may very well come up and say that this was something forced on me, but the amount is small and I don't want to get into litigation. So I've just paid the tax amount or something. Now, in such a case, the asset or whatever is disclosed may not get into the books of accounts. Now, that is what the auditor and the company will have to say, that we have paid this tax, but it is merely to buy peace and there is no such asset which is existing. Now, writing that is one thing, but as an auditor, when you are doing that skepticism, it really means a lot of things. It also means that could there be some other actual items which are not really disclosed by the company? So that asset 240 and your professional skepticism really can play a big role there, and your reporting under fraud, what happens in your earlier cases, because the company may very, very well say that I've disclosed this and paid tax for the last 5 years. Now, does it mean you go back and find out what went wrong in the earlier 5 years? So this is a clause which looks very innocent, but it can have tremendous implications for the past reporting and whether an asset is there or not there. I'm sure a lot of us read in the press in the last 2-3 weeks about a large group being searched or raided by the tax authorities. And there was also something in the press that a lot of so-called dummy expenses were debited in the books of that particular company. Now, as an auditor, actually, I'm waiting to see what is the report going to look like in that particular clause. And since it's a listed entity, I'm sure I'll get something by the end of May or something as to what is the report on that, because that is something which was just done recently. I believe the department did that whole action to really test out the reporting under this particular clause, because that's probably one of the largest things which we could see in the press in that sense. But it's a difficult clause, though the guidance note tries to restrict the auditor's perspective. Still, nonetheless, I think if any such action has taken or any such taxes have been paid on so-called additions on search or surveys, auditor will have to be extremely cautious on how to go about it.
No, it also creates a ripple effect. See, if you're
Yes.
reporting something there, then under 143.12,
Correct.
on CARO clause. And the next question is actually to
Sripriya, there are two more things in what he said all about. One is the angle of internal controls. That whenever such things happen, what was happening to your sale, purchase, stocks, and whatever it is, if the asset is accepted or added in the books, then there is an issue. He said that it is not added, then there is an issue. But if it is added, then how that got missed out? And you are giving IFC reports also is one of the angle. And second angle I want to put it, there are several press reports on GST going all out in going rates. Now, this was only income tax. Like MPV said that you will have increase in the questions in future. There can be a raid by GST. I don't have to tell you about the listed company where it was found by GST authorities that fake units have been created by them and they were taking purchases and claiming the ITC on that. And huge, I mean, it was some 247 crores or something was like this claimed or something. Now, and then that company fell off. Even in the markets, it was a huge problem. Now, this kind of things will have an internal control issue. For the auditor, it is not only that how he escaped that, but how the controls are working or not working would be a very serious issue for audit. It is not that a particular expenditure is wrongly booked and he has the voucher and he has the the order and everything is okay in SAP. That is not going to work. Finally, expectation of the society is far different. And this is one case. They have asked about income tax, but it will come on all the laws in the times to come. Yes, you can go on the next question. I will just.
Yeah, no, you're. In fact, the next was to you only. But you.
Yeah, bolo. Yeah.
See, in some sense, this issues in CARO are not going to be just linear to CARO. It goes back to your IFC. It goes back to your 143.12. It goes back to the main report. So anyway, it as it may, I think it'll have to resolve itself, and that's the nice thing. I mean, everything will be fine in the end. So the next question is for Mr. Bhaskar. So we started talking about frauds. Now you have SA 240, you have 143.12, then you have CARO. What was the need to have this in so many places? I mean, in any case, there's also a basic aspect of being no material misstatements, and it's free from fraud or error. So what is your take on this? This is going to make this more complicated. Did 143...
Sorry, Priya, can you repeat that? Sorry.
No, I said there are multiple references to fraud everywhere. There's 143.12. Now there is something specifically embedded in CARO. In any case, my true and fair opinion meant my financial statements were free from material misstatements, whether due to fraud or error. So is there an overarching emphasis on fraud management by the auditor? And is this going to cause an even larger expectation gap? As it is, we as auditors think we are doing this, or we are supposed to do this, and the rest of the stakeholders think we are doing that. So will the gap between this and that be even more lethal than ever?
Yeah. See, anyway, as an auditor, you're supposed to take the fraud into consideration. If you look at CARO, there are specific angles which they're asking from what you're supposed to report. One, I would add the vigil mechanism or the whistleblower aspect also. You're supposed to consider that. And then branching out is that whether there are any frauds on the companies. The earlier CARO talked about only the officers or employees of the company. Right now, it has been kind of enlarged to include any type of fraud by the company or on the company. So therefore, the investors need to know about what is the kind of governance mechanism which is happening inside the company in terms of there any fraud which are being kind of reported to the shareholders, to the stock exchange, or to the third party. So so they wanted to bring that element of transparency into that. And also from 143.12 reporting, see there are a lot of judgment calls which is taken. Who has identified the fraud? When to report to the central government, right? There is time frames which has been given, whether it is identified by the auditor or identified by the management. So it's typically 143.12 kicks in only when it was kind of identified by the management, and the management has not taken adequate action. So therefore, you have to report it. So therefore, it brings it a consistency with what the auditor is doing to the external world, with what to the central government, to what he is reporting to the stakeholders. So as MPVs have talked about in terms of one for a regulatory angle of it, one for what you are giving to the investor. So therefore, they want to give more to the investors, whatever you are silently giving to 143.12 to the MCA, just put it on your report as well. So I would look at more in terms of consistencies, what given to the regulators are put out from a reporting to the external stakeholders.
So, and again, come back to the same thing. I just hope people will read all that we are going to write.
Shripriya, just to add something, this reporting under no player, which is in the code of ethics, though it has been postponed by 6 months, I think auditors may also now need to look at those provisions where if there is any non-compliance with any laws and regulations, it may actually come in the main report, not necessarily in CARO also now. So I think this reporting on fraud along with this no player as it when it gets reported is going to create challenges for the auditors, but also at the same time give a lot of information to regulators, users, and others.
Sure. And so thank you very, very much for being here today. And if I were this whole event is drawing to a close, and we're planning to have a series of sessions where we're trying to more focus on why CARO, so that we are able to deliver the expectations of CARO better rather than how CARO, which I'm sure AASB would also be doing fairly well, and we do joint programs as well. So if I were to summarize and conclude this session, could I please invite in the reverse order, and I would like Amarjit to speak in the last, just 2 lines on how do you think this whole thing is heading? And when I talk CARO, audit and corporate governance, what adjectives come to your mind? Could I start with Bhaskar?
I would put more responsibility on us. Be more careful when you're reporting. I would say put your foot down if there is an issue, right? Nobody going to save your membership unless you, right? So we have to save our membership. We have studied hard to get this membership, right? And we have to be focused, not get under any pressure. That's what I would put it.
Mr. Vijay, thank you. Thank you, Bhaskar.
Sripriya, I think my view, it's about staying relevant. If the profession has to stay relevant and you want the stakeholders to use its services or rely on what we are giving, I think it's important we have to walk this extra bit.
With the nation, absolutely. So, Mr. Himanshu?
Yeah, clearly I agree with both Bhaskar and MPV that auditors have to maybe buck up their sleeves and get into more reportings and be very sure and take the responsibility with conviction. But at the same time, I think the institute or MCA can also play a role that if you need such reporting to be done, there should be commensurate remuneration also. Because that is something which I believe I thought someone would talk about it, but I thought let me at least raise that commensurate remuneration so that the teams are trained, you spend that time to dig out all these things. That is equally important. Otherwise, how will you justify all this reporting which is there?
Sure. Mr. Srinivas?
Yes, I think this is what Sir Amarjit sir said is about my independence. I am actually supported by government in commenting on several things where I was avoiding commenting probably or had difficulty in commenting. Now, we already talked of, say, title dates. We can talk also on something like, loans to other than the related parties. For example, now such things, if they are rolled over, if the loans are without specifying terms, in fact, the loans to other parties can be, that in turn will go, it is a camouflage. It will go to related party later on, that amount. And this is actually diversion of funds. Money has been collected from shares and debentures and everything for the business of the company. When you give it to non-related parties also, and for what reasons, etc., it's going to be difficult when it is rolled over, and it can be a camouflage. So actually, now I'm strengthened. If you see that what Sir said in the beginning, we can end with that, saying that this is where I'm strengthened, and this is where fearlessly I can report, saying that now government wants it. You also said, Sripriya, that now since government wants it, I mean, even Sir said when government wants it, I have to give. What is that? So now actually, whatever I would not have, 143.1 says so many things, if needed report, we don't, journal entries. Now that 197 comes, we say, or the sections come there. Now we need to see that, yes, that is, that is required to be 192, sorry, comes, and I say, okay, those journal entries are not, it is prejudicial to the interest. Now, this is where, I'm supported by law. I'm very happy that such things come up, except that there is an information overkill. As MPV says, this should reduce continuously. It cannot increase. I'm not afraid of increasing responsibilities at all. But I'm saying that more and more things, management reports coming in this, and again, I have to comment on that. It's going to be very heavy, and it will create, something beyond. Actually, I am looking at true and fairness of the accounts, and instead of that, I'm looking at so many other things along with that, which may or may not have direct impact on true and fairness of the account. It's something, but still, I'm happy that the government is supporting us. So we in there as a nation building partner, we should also support government. I think in the endeavor that they want good corporate governance, and it will happen definitely through this initiative is what I feel.
Thanks, Srinivasji. And if I were to, sort of describe what you said poetically, maybe the CARO will be the wind beneath our wings. So over to Mr. Amarjit for your concluding remarks, sir.
I think whatever has been said, either by Bhaskar or MPV, Srinivas and Himanshu, I do go with that. I will only say the CARO has come in because of certain, I think MPV said it to begin with. It has tried to bridge the expectation gap. Let's be very clear about it. And I think this is one purpose that it is going to serve in the longer run. And it has also come because of our non-reporting or inaction on the part of the managements. very frankly, in respect of various issues. So whenever we fall short of public expectations or the regulators' expectations, these things are brought in. Now, they have brought in, we cannot say that we didn't know that we are supposed to do it. Because in most cases, what had been happening earlier was, people used to say that where is it said that I'm supposed to comment upon the stocks with returns which are being submitted to the banks. Now they said, no, it is here. We are expecting you to answer this particular question. And even if it is not given on the same date, because most of the time the stock statements which are given to the banks may be on 27th of June or 29th of June, you reconcile it for 2 days and come back to us basically. You can't say that since it is not on the same day, so I am unable to answer this particular question. So similarly, with regard to the auditor's resignation, capital work in progress, aging of the debtors, aging of the creditors, all those things, and particularly the related party transactions, wherever these advances, etc. I personally feel, very frankly, I've been telling my own office people, I feel strengthened. I feel strengthened both as an auditor, as a director. Also, believe me, there is no doubt about it. Today, I can tell the promoter that this is what has been laid down, and I can't feel shy of it, of asking this question. And the promoters are trying to veer around that particular idea. So I personally feel I'm in a better position. The only thing is that I must now capitalize on these, better position of myself, both as an auditor and as a director. If I don't do it now, I think I am going to be irrelevant, both as a director as well as an auditor. So it is for me now to actually strengthen my position and see to it that I remain relevant to the society at large.
Sure. Thank you, sir. So just in terms of a wrap up, I think the key adjectives that I could pick up were confidence to the auditor, caution, risk, responsibility. I love this theme of relevance. I think it's very important that we be relevant to the times that we operate in. So thank you for these wonderful inputs. And of course, the other good part, the important input was remuneration. Good, commensurate remuneration, which I think is also very important, because I think better fees drives better quality, and better quality drives better performance, and better performance.
I will only say, Siripriya, no regulator, whether MC or institute, will be able to fix the fees.
Sure, sir.
It will be for the chartered accountants to negotiate, to value their own time. If we don't value our time, no one else will be able to do it. I can tell you very correctly, if we lay down a minimum fee, that will become maximum also, very frankly, whether MCA says it or not. So it's for us. I still remember Sachin Tendulkar case against the chartered accountant, basically, where the Tendulkar had reported that he has overcharged me. And the institute came up with the finding. I think Mr. T.N. Manoran was the president at that particular point of time. And we have actually observed that it is a relationship between the two. Whether it was, when you say that I am satisfied with your service, in that case, whether he is overcharged or not. Similarly, if you are satisfied with your client, whether you have undercharged or not, nobody can come to your rescue. It is for me to charge a particular fee under all those circumstances. I think we just cannot keep on saying that the regulators will have to fix the fee. There is no way that it is going to happen. Otherwise, the clients will give you the check and take away the cash. Believe me, mark my words today. We cannot afford that kind of situation. We should value our own time as to what time we are giving, basically. And I think I am saying it to the smaller chartered accountant. I am willing to say it to the bigger chartered accountant also. Value your own time, charge your fee, which you feel to be relevant, basically, and commensurate.
Sure, sir. Sure. Thank you. Thank you very much to all these wonderful gentlemen. Thank you to Ms. Preeti Savla, who's the vice chairperson of the committee. And thank you to Sarika Singhal, who's the secretary. And there are many questions which are still continuing to, sort of plague our minds on whether CARO is moving an auditor's responsibility from solvency to liquidity. For answers to questions such as these and more, please look forward to another panel in a couple of weeks or a week's time. Thank you very much. And I hope all the members of the audience also enjoyed this session as much as we did. Thank you. Thank you very much.
Thank you very much.
Thank you everyone, all the panelists. Thank you very much.
Thank you all. Thank you. Sir Chopra sir, this year it is all women leadership in CLCGC.